I think the main thing is take the first step and don't be afraid to do it. Going back to 2009, I would say, learn this business a little bit deeper, faster, and then don't be afraid to take the first step, because a lot of this time it's just the way we're wired. You don't understand that there's a gap between your comfort level and your potential.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, you had a tough situation this month, didn't you?
Well, Eric, yes, because I was disappointed. There's so many things that go into looking at a real estate investment, and sometimes what people forget about is the financing. We had a situation, we manage properties, and our client has a good property, but they went out and they got a loan with, I think it was a 10-year amortization.
Yeah.
And so the loan payments are so high, it makes it really difficult to work. So instead of refinancing and just evening out the cash flow, they got frustrated and want to sell the property, and I just don't feel like it's the right move for them.
Yeah, I mean, the problem was, we took that property over. It was in distress. The loan was rated by the bank, and a rated loan basically means a loan that is not performing properly. Was not performing properly because the amortization is too short. And, we're within a few years of the owner's within a few years of paying it off. But the reality is the cash flow situation, which was self-created by the bank and the investor, wasn't where the bank needed it to be. And so they rated the loan, and now she can't move the loan because the loan's rated. So it's just it's a stressful situation unnecessarily. The property performs, but
the sad part is we've brought it up. It is performing now.
Yeah, it's performing, but it's what happens sometimes. I mean, people get a little bit too ambitious of what they think they can do on a property in terms of debt payback and whatnot, and now they're stuck and they can't do anything about it until they get completely out of the loan, and then perhaps they can try to refinance it then, but they can't take it to their bank right now. So it's just they have to deal with the situation. And now she's talking about selling. If she just would hang tight for another couple of years, she could
she'd own it free and clear, actually, because it's being paid off so quickly. And actually, if you have to go back and talk to that same investor again, let her take out a 25-year loan and pay it off sooner.
Yeah. Yeah, and that way she controls when she wants to pay down principal, as opposed to having a fixed payment. And it is what it is where she is now. But just something to keep in mind when you're looking at the cash flow situation on a property that you might be investing. Don't let your eyes get bigger than your belly. So something to consider.
Or your pocket.
Or your pocket. There you go. Guys, we always love when our listeners give us ratings. It helps us with guests. Guests will go on to our show on iTunes and on Google Play Store and iHeartRadio and a number of other places and see who is saying what about us. Are people actually listening? And that helps them make their decision on whether they're going to come on the show. And if we continue to get great guests coming on the show, it only helps you guys. And so if you have not had opportunity to give us a review, we certainly appreciate it if you go on to either iTunes Store or to the Google Play Store or iHeartRadio or any of the Stitcher, any of the number of places that we can get a review. That way we can share those reviews with our potential guests and hope keep up the great level of guests that we've had to date. I wanted to thank Tone21, who says, very knowledgeable hosts and guests. Always enjoy listening to the podcast. Thanks, guys, for all the easily accessible, great information. Tone21, thank you for leading the way and showing people how to do it. We really appreciate that you spend time listening to us each and every episode. Stephen, is there anything else? Oh, what are we're talking today about Gulf Coast Investor, right?
Yeah, I mean, we have our meetings where people come and we meet really interesting people. This happens to be an old friend of yours and who jumped into real estate investing, so it's going to be good to learn firsthand what he's been doing.
Yep, looking forward to getting caught up with what he's got going on with his investing, and I hope that you guys will get something out of it. So let's go ahead and get started with our guest.
Today we have with us John Wilson. John is CEO of the Florida Property Group. He owns income properties, primarily multifamily and commercial. John had a long corporate career with Fortune 100 companies. Before he started investing in real estate, he was a VP of sales of a publishing company. He also looked at franchises and student rentals. John, welcome to the Invest Florida Show.
Thanks, Stephen.
Hey, John, really appreciate you taking the time and talking with us. Have to disclose to our listeners that I've known you 40.
The math gets really scary sometime, but
47 years,
1980-ish, 79 maybe.
Yeah, long time.
And he still walked in the door.
I know. Imagine that. Yeah, I've known John since junior high school, and we actually graduated from the University of Florida together and have stayed in touch. John took a different path. And ended up in the corporate world, and then got into real estate. But I had to disclose, so if I tell any jokes on you, that people will know that I'm not being rude.
Okay, gotcha.
So talk to us, John. You originally started out in the corporate world, and then one day you woke up and said, I want to get into real estate. Is that how it worked?
Pretty much, Eric. I did everything you're kind of ideally supposed to do. Graduate college, go get a job with a big company, have nice benefits, worked for a long time, which is all very good, and enjoyed it. And it was beneficial lifestyle for me to do that. But after a couple of decades of that, it was like, okay, I'm kind of ready to do something more on my own, and started learning more about what it's like to worry about your balance sheet as opposed to your income statement. And I think you had a previous guest on here recently who talked about he was in a corporate career for about 3 months and decided that, okay, I'm going to do something different. Well, it took me a couple decades. I'm a little slower, I guess. But but no, eventually I started looking at a lot of different avenues to kind of create different income streams. And eventually in 2011, pretty much settled on real estate.
I think it was, as you said, it was really more about having control than it was about anything else, right? So that's why you're looking at the franchises. Yeah,
because we spent a lot of time on some national franchise brands, looking at them, and got pretty far down the road with a couple, even to the point of, going through site selection and stuff like that. And then it became a battle of the site that you want's not there, the territory you want's not there. And I sort of backed away from that. Real estate was not necessarily something I had a real passion for up until this point. And it's still more of a vehicle, I think, than it is a destination. I like it, and I like the lifestyle it provides, but in the past I was always kind of shied away from real estate because it's pretty intense with fees and so many transactions costs as you acquire properties and stuff like that. But I didn't know a lot about it, but I've kind of gradually starting with very small properties and now getting to some maybe medium-sized properties, kind of learn what's going on.
So how did you start? What was your first property?
First property, Stephen, was in 2011. I always need to have somebody to look who's ahead of me in something that I'm doing. So I have a friend that we see a couple of times a year who does a lot of student housing out west. And so I said, okay, I went to University of Florida, so I'll buy some stuff in Gainesville. So we bought 2 very small condos there, and then rented them out to students. And it went very well. It's kind of funny, though, before I bought those, I had the same idea in about 2008 and 2009. And one of these properties I looked at the same time then, the exact same property, and it was triple the price of what we bought it for in 2011. And it wasn't a situation where I knew the market was going to crash or anything bad. I mean, sometimes things happen to us, or sometimes the deals we don't get are beneficial as the ones that we do.
Oh, yeah.
So then we came back, and the reason I did not buy them in 2009 was I was with a real estate agent up there, and they kind of dropped the ball on some stuff, and then I got a little lack of interest and distracted and just never revisited it. And then came back in 2011 and bought one property out of foreclosure at a very cheap price, and then another one that was kind of on the way to foreclosure.
So I guess when you made at some point you had an epiphany that it really wasn't about control, it was about cash flow.
Absolutely. Yeah, I'm trying to replace income because I had a very healthy salary in what I was doing. I had progressed in my career over a long time. But no, it's like, okay, what can I do to gradually replace the salary I'm making so that one day that I am living off of this and not off of a salary from a company.
And so the franchise situation was about control, was about replacing your salary, and then you had really an epiphany that it was really more about cash flow than it was about control.
Yep.
Because of a series of events that occurred. Like it was difficult for you to put together a franchise deal.
Yeah, there's a lot of stumbling blocks to it, and as you dig into those deals, you have a lot of fees that you pay back to the franchise headquarters and things like that, and it's not quite as presented as you learned for it. Again, there was a couple of them that I really liked, and if the real estate part would have worked out, I would have done them. But it got to be a battle over that, and then the money. As you dig into a lot of those opportunities, you learn that their FDDs, which are the disclosure documents they have to show you. You start talking to individual franchisees, and it's like, well, the revenues aren't quite what we expected, and the build out was more than we expected. So then you start squeezing that margin a little bit. And it's like, this is not quite the return I'm looking for the effort it's going to take.
Yeah, you're buying yourself a job.
Yeah, some of them you absolutely are.
Yeah.
So do you still own those apartments?
Stephen, actually, those I held them for about 3 years. I sold them in 2014, and that was really kind of woke me up because at that point they were very low maintenance for me. They were apartment units that were or condo units that were in complexes. So there was not a lot of maintenance on my part. And then I also had a property manager that took care of the properties too. So for me, they were almost turnkey properties as long as we kept them full. So I go, okay, this is okay. And then I was looking at some other properties closer to where I live. And
that's Sarasota. You're in Sarasota.
I'm in Sarasota, Bradenton.
Yeah.
So I got to the point there where I was going to sell. I sold those properties. It's like, okay, well, over 3 years' time, we made about a 60% return.
You came out of the recession?
Yeah. But it's about 60% or so return compared to what I bought them for. Then you factor in, they were making about 9.5% return per year. It's like, okay, there's something to this real estate thing.
Was it always multifamily, or did you jump into some other things that?
No, I tried some other things, and actually part of it was through the help of you guys too. I think one of my first commercial units I found a listing that you had. But so after I sold the properties in Gainesville, I wanted to have some stuff closer to home. So I bought a commercial property in Pinellas County. Had a national financial tenant already in place with a very good lease and a very good rate of return. So that was 2014 I bought those. And
those are duplexes?
There's
another one.
That's the office condos.
They
were condos.
Right,
okay, so you had fees and you factored all that in.
Yeah, so we had fees, we factored all that in, and then the commercial lease and that business was new to me too, but then you learn quickly that the tenant's pretty much responsible for everything inside the walls. And since they were in a condo situation, the outside's pretty much on the association as well. So I like that pretty well. And then at this point, I'm liking the real estate part more and more. And I'm also kind of wrestling with, understanding what it means to take on debt, whether it's good or whether it's bad. At this point, actually, in my investing career, I'm completely debt free. There's no debt personally, no debt on the properties. But I'm looking, okay, well, wait a minute. This cash on cash return, if I can make it work, is a little bit better return on my money.
Yeah, I mean, particularly when you start talking about multifamily and you get a 3.5%, you're getting a 6 cap. It really juices the cash on cash return. Yeah.
So at this point, I feel like I'm ready for something that requires a little bit more work on my part because the properties I've owned so far have been almost turnkey. So I started looking for multifamily, and then in 2015, I bought an 8-unit complex in West Bradenton. A combination of efficiencies and 2-bedroom, 2-bath units. So for me, a lot of people that you've had on in the past, that'd be a very small property for them. But for me, this is a big property. It's like it's a property that needs a little bit of work. It's going to require some more management on it and things like that. So I bought that in 2015 and then kind of dug into the multifamily from that property.
Well, let's talk about that apartment building a little bit then, John.
Yeah, because that really gave me an opportunity to kind of really dig in and learn more how you increase value in a property. Again, 2015, the cap rates weren't kind of as crazy low as they are now. I think we bought that. It was quoted at about an 8 cap, and actuality
it's Class C.
Yeah, Class C. Yeah. But actually, realistically, about a 7 cap. But I bought it and started looking for opportunities and what I could do to increase the value of the property. And the first thing, the rent seemed low. Even the 2-bedroom, 2 baths were in the $750-ish range for rents. Separately metered for electric, but just one water meter for the building, which was not being billed back to the tenants. So what first thing I did was after a few months, and also something on this too, is they were still paying with checks and money orders. So that I go, I can't deal with that, or I don't want to deal with that. So we got the tenants.
Yeah, having to drive up there and chase them down. And
yeah, I mean, everybody paid it. That was never a hard issue with it. But so we went to an electronic billing system, which made it very simple. They get an invoice each month. They pay it. It goes to my bank. So that cleaned that up. And then
did you self-manage, or did you have a property manager?
On that one, on that one, there's a tenant that's been there for a long, long time. That sort of is the first point of contact. It takes care of the kind of the basic maintenance around the building.
You gave him a discount on the rent?
He gets a discount on the rent, and then anything beyond that we pay him hourly for. But just very basic stuff. And then also have a couple good repair folks and handyman folks that are on call for that property. That's a pretty low maintenance property at this point. But so the first thing is our rents came, or our leases came due on that property. We started billing back, or used the RUBS system. In fact, we even invoiced it as RUBS. Everybody's like, "What's that?"
Yeah, talk about RUBS, because that's
it's basically where you're taking your utilities. So it's a ratio utility based system, and you're billing it back to the tenant. So what we do is we have again, electricity is not part of this because it's already metered and that's on them, but we take the water, sewage, trash monthly bill. I knock off 10% of it to cover any things that me as the owner incurs on the cost of that. And then we divide it across the units by the number of tenants there. So if we have 16 tenants, we divide it by 16. If you have 2 in your unit, then you're multiplied by 2. Sounds like a small thing, but again, this is not a big property, but that adds about $4,000 or so to the bottom line. So you start looking at the cap rate and cash on cash return. That was a pretty easy one to get.
And also the leverage. You add $4,000 to the bottom line.
Yeah.
And what that does to the value of the building now.
Yeah, absolutely.
Yeah.
And so, but again, that's one thing I like is I'm learning about multifamily too, because my knowledge about real estate in the past was, okay, you buy a single family home or something, you hope it goes up in value, and if it does, it's great. But I feel like with multifamily that I have a little more control, because I know if I can drive the NOI on a property, I'm driving the value. Whereas I'm not quite as held ransom to, well, the market says this, or the market says that. As long as I can drive my rents and profits, that I can drive the value of the building.
Did you look at separate meters as
Steve, that's a good question. We did. We looked at doing it straight up to the utility company, and that was a fortune. It was not going to be worth it at all. Plus, it was a lot of labor to do it too. And I'm going to forget the name of them, but there's also several companies that will put a metering device on your intake by the water heater, and then it's almost, I think it's an online building when you go back and look and modify the building.
Correct.
But at this point, I'd had the RUB system in place, so I felt pretty confident that I didn't need anything extra on it, because I was getting the money without having to put the expense there. And then next, we were kind of gradually started raising rents. So those.
And this with the RUBS? The RUBS is in place, and you started.
RUBS in place. And
how did you originally start telling tenants about the RUBS system? I mean, I hear some horror stories from landlords about half their tenants leave. They start talking about you start talking about passing on the cost of the water. I always got it for free, and just out of despite, they leave.
First of all, I waited to. I read some things online that says you could actually pass that through before a lease was up, but I waited till leases became due. And so what we did is we had some other changes in the leases too. So at the same time, we said, okay, if you'd like to renew, here's a couple changes to your prior lease that you're going to have. And one of them was just kind of explaining what we do on the water and the sewage, that it's going to be billed back. But the pushback was not strong on that.
Okay.
And then another thing we also did on the leases and trying to tighten this up is, again, I'm new to this business, but I always thought that, okay, you automatically have a 5-day grace period on your rent. I thought that was like some kind of law or something, but it's not. So what I did, again, talking to some other folks who are a little bit ahead of me in this business, it's like, okay, so we tighten that up to 2. So, rent's due on the first, late fees apply after the second, just to kind of get that collection rate faster on the first week of the month. But pushback was not really bad. A couple times we were trying to gradually raise rents too. Prior owner had rents well below market value on that. So the first year we took very minimal rate increases on the rent, but then also added the RUBS in. And then after that, we've raised rent on top of the RUBS.
And what are your typical rent increases?
See, again, the 2 bedrooms here were in the $725, $750 range, and now we've got the 2s that are up to $900 to $1,000.
Wow.
Yeah.
That's
so
significant.
that's in 4 years' time.
And you talk about not wanting to collect checks and money orders. So what have you done to change that, and how did that system go?
That went pretty well. It's a little bit, the pushback we had was not necessarily that people were against doing it. It was just it was something different. It's like they've paid forever with a check or a money order, and we used to always give the rent to the guy who came by to ask us for it and stuff like that. But basically, we just explained and then made it very easy for them. Actually, I mean, a couple of tenants I actually showed them, hey, when you go online, here's the link you're going to get, and here's how you link it to your bank. So the pushback was not really hard on that unit. I know later on we're going to talk about my most recent acquisition, and that one had a little more pushback on the electronic payments. But the original one didn't. And then they also like the fact they get an immediate receipt. There's never any question about who'd paid, when did you pay, and things like that.
Yeah, timestamped and whatnot.
Yeah, your timestamped.
Fighting
so,
about.
Yes.
So at this point, were you liking the multifamily more than the office investment property that you had?
I like them both equally at this point, but I saw that it's kind of a trade-off because on the office investments, it's a very simple, low maintenance lease on my part. But on the multifamily, I started to learn that I can drive the value and increase the value more rapidly. So if I have a tenant on a 5-year lease for the property, that's a great thing. But then I can't drive that value beyond that over that 5 years because I'm pretty much locked into what I have.
So, so you've seen it's about finding something where you can get some upside out of it.
And in today's market, that's where it has to be. When you look at what the cap rates are, you have to see some kind of advantage in this marketplace where you can add value to the property and you can generate more revenues.
Yeah, and that's the issue. I mean, we've seen the compression of cap rates so much over the past really 9 years that you've got to figure out some way. You've got to be creative about finding ways to add value to the property. Whether it be rub system or adding washer dryer, whatever it is, you got to be more creative than ever to try to increase the cash flow on the units. And as you say, with a commercial property, and of course we're not going to bash them because we do a lot of those and we like them, but it's tough when you've got a national tenant on a 5-year or a 10-year lease. There's not a lot of wiggle room for what you can do with that.
Right.
Yeah.
But it's a trade-off too, though, because when you have that national tenant in there.
Yeah, it's not labor intensive.
Yeah, and you know what it's going to be for the next 5 years.
Yeah,
and so in the course of your ownership of multifamily, did you learn how to repair a toilet?
A little bit. I can do some handy stuff. I'm not great at it. Although whenever each property we've bought, I'm a big believer on. I'm going to make sure I know everything about the property. So I don't do a lot of the work myself. But not to back up a little bit, but the first unit we bought in Gainesville. 2011, it's August, which is very pleasant in Gainesville. It's hot and nasty. And these units did not need much work at all. But I go, this is my first unit. I bought it, so I want to check it out before we have tenants move in and whatever. So basically what I had to do is, my family was up there with me. All I would do was clean it. So we're getting it all ready. And then I'd recently been promoted to a vice president job. And then I guess there's different levels of vice presidents. It wasn't a huge vice president job because we have I was a VP, then you got senior VPs, executive VPs, and all that stuff. And so my phone rings. It's an executive VP who I hear from twice a year, who's kind of just more or less a stuffed suit and rambling on and on about some window dressing thing we need to do for something. It's like I had more fun cleaning out this apartment than dealing with this. And that was kind of an epiphany for me. It's like, okay, I didn't make the change right away, but it's like, okay, I want to do that instead of what I'm doing. But no, Stephen, a lot of the stuff I've had really good luck finding people that stay on to do maintenance and things like that.
I mean, that's a key issue for people in maintenance, particularly when you're owner of smaller numbers where you can't employ somebody full time. And so it's interesting to hear that you've really not had issues with it, because it is a question that we continually get, that how do people deal with the maintenance? In fact, we had somebody write and say, you guys need to incorporate into your podcast asking the guests about maintenance, because my maintenance guys, I go through them like underwear. I sometimes they show up, sometimes they don't, sometimes they're busy and I can't get them on a job. And so, when you've got these types of issues, it sounds like you've had good luck with it.
The Manatee County property I have, the most recent property that we'll get to talk about later, I've been through several maintenance folks there. But again, when we get to that property, we'll talk about that more in detail. But the Manatee County one I've been very, very fortunate with.
So staying with your first multifamily, you like that multifamily, you found the path to increasing value and raising your NOI. How did you proceed next?
What I did next, because I was still open to commercial as well. I like the multifamily, but it's not as easy to find the multifamily. And so that's move on to 20. Actually, I quit my job in 2016, September 27th, 2016. And I always like to hedge everything that I do. And the industry I was in was kind of contracting a little bit. And each year we always had layoffs and things like that. So I'm thinking to myself, just to be safe here, I would love to be laid off in my job. So give me 6 months of severance pay and then start full time this real estate business, and then have a little bit of a cushion. So I'm in May of 2016. I'm at our home office in Princeton, New Jersey, and our president is in town that week too. And actually, I like him. He did a good job with the company. And so I go down to his office and I say, hey, last several years we've always laid folks off. But I go, next round of layoffs, could you put me at the top of the list? He's like, what are you talking about? I go, I'm ready to move, and I'm going to eventually leave, so I would save somebody else their job and things like that. So lo and behold, that's the first year in a long time we don't lay anybody off. And then, so I still worked for like...
You started drinking in the office?
So I still worked there for 5 more months. And it was interesting because he kind of kept his word, did not tell anybody about that conversation we had because it would have been a little uncomfortable with my direct boss. But no, so finally in 2016, I leave there. I'm getting to answer your question eventually here, Stephen, about what was next. And so there was no big party when I left where people called me up and say, hey, you're a full-time real estate guy now. I've got all these multifamily deals for you. Come on, John, let's go.
They waited for the party till you were out the door. Then they had the party.
Maybe so on that. But so I was a little frustrated because I didn't find a property for almost 2 years on the multifamily front. Early in 2017, the commercial property I own in Pinellas County, the next door neighbor had a health situation where they approached me and said, look, I'd like to sell you the business and lease back for you on a 5-year lease. So I did find that deal not long after leaving my job. So that gave me the small multifamily building plus the 2 commercial units. So that was enough to keep me going, but I was anxious to find the next deal. And
that's never a good thing, like under duress trying to find.
No, and it takes patience because you're ready to go on stuff. But I kept looking and looking and looking. And for folks that are starting to do this right now, it's frustrating to look. But the more deals you can evaluate and really understand the pro formas and digging into the vacancy rates and ROI and all these projections, it really helps because after a long time of doing that, you can kind of eyeball a deal initially and say it's probably good, probably not good. But I started expanding the area I was looking at. Looked at stuff up as far as Crystal River, and as far south as Fort Myers, and probably put in formal offers probably on a dozen properties.
And you like Fort Myers, like you kind of honed in on Fort Myers.
That's where we finally found a property. I got to the point too where we're bidding on properties. I wanted to be between the 15 and 20 unit number of units roughly, and then in the $1.5 million to $2 million range for price tag on it. And so I'm looking at properties that are I'm bidding right up against the ask price, and they're coming back, hey, it's a good price, but can you do this, can you do that, or how much can you go over the ask? And this the property's been listed for 7 days, and so that got a little frustrating, but a lot of those came and went. So finally in July of 2018 I lost out on a property where I literally offered the ask price on it, didn't get it. The agent said, I've got one coming to market soon. Do you want to go look at it? So I literally bought it before it was listed.
Yeah, hence your another epiphany that getting stuff off market where you're not having to compete with people is
yeah. But the buyer, there's a large company that owned that group of apartments. It's 17 units. But they were also still at the same time as we're going through the closing process, so it took a long time. They're still, trying to market it and say, well, hey, we can get this for it, we can get that for it. It's like, there's still a lot of negotiations going on. But no, that finally got one, almost 2 years later.
And that you said was 17 units?
17 units.
Nice size.
And so you're telling us that you had some issues with that particular. Oh, and just to kind of summarize, you talked about it a little bit, but I want to emphasize it. We have so many people that come to us and say, find me a multifamily. Just give me a multifamily. Get any money at multifamily, and you just hold your breath because you're saying, look, the best deals are made on the buy side. So you're patient. You'll find the deal, but it might take you longer than you think it's going to take you. But sometimes people are under duress. I mean, they make decisions, investment decisions, because they're in a 1031 exchange, or there might be a number of other reasons that they're trying to, and they have the gun to their head. And although we have had instances where people do okay in those types of situations, more often than not, when they're under a time duress, they pound a square peg into a round hole.
Right.
And this market's tough.
Well, it's tempting to do that because you're ready to go and you want it to happen.
Right.
But if you get in on a deal like that, that's not a good deal. It's hard to get out from under it.
Yeah.
And is this the property that you said you had problems with maintenance?
Yeah, let's talk a little bit about some of the issues you had with this.
Sure. So I'm coming up on the year anniversary next week of owning this property, and we're pretty much on track. But the way my properties have gone that I bought, not necessarily planned perfectly, but looking back, it looks like it kind of was. But each one's required a little bit more knowledge and expertise on my part. This property I would not have been comfortable buying 5 years ago. But now I feel like as I moved up a little bit, I can address what needs to be done here. But 17 units, it's townhomes. They're all in a cul-de-sac together. They're in North Fort Myers, and they're Class C. I didn't really land in Class C on purpose, but as I kind of learned Class C properties, I like them. It's people who go to work and are servers and plumbers and
working people.
Yeah, working people. And I think I look at some of the Class A stuff. First of all, it's usually institutional investors that are much bigger price tags than I can too, but I just don't see where the return is on that compared to what I do. Anyway, so we bought it going in, or year zero cap rate, I think was quoted about 7.5%. That was relatively accurate. But the upside on this property was, because the 7.5% didn't really get me that excited, but 'cause I invest in equities and things too. And I think in my lifetime, I think I bought my first stock in 1986, and the market's been up about 11% or so per year since then. So
sure, it's
got to make more than single digits, otherwise it's not worth the time and money if I can get it to that point. But the upside on this property was it needed a lot of work. Average rents going in were $853. The prior owner had just gradually raised some rents, so they had some scattered up, but actually obtained a couple rents up close to $1,200. So the whole complex wasn't there, but it's like, okay, there's an opportunity to gain some more rents here. So what I did, I went through the inspections, closed on it, and at this point too, I'm also wrestling with the debt idea, because before I was always debt free, and I took on an amount of debt on this one that 5 years ago I'd probably never sleep a wink at night at, and it doesn't bother me at all now. That could change in a few years, but to get this size property for me without having a partner, I need to take on the debt to do it, and that we factored that into the projections as well. But anyway, this one's a lot of work. I think across the 17 units, we budgeted about $115,000 of upgrades. And so as units have turned, what I've done is, flooring, kitchen, paints, whatever needs to be needed, but to try to hit our target rent of like $1,200 a month. So that's what we're kind of working for. And so I start off with, you asked me to talk about the maintenance folks. I start off with somebody who was referred to by the prior property manager. On paper was very, very good, but very slow work, couldn't show up. Has a girlfriend working with them, and then that leads to a whole bunch of mess, and they both are this and that, and they start asking for
throwing tools at each other in the front.
Almost to that point, and then, but no, and I've got an on-site property manager here too, so she's involved in the day-to-day with that much more than I am. But they get to the point, well, we need to do this job, but can you pay half of this up front, and then we'll do that, and then they're taking forever to do it, and then if the units, they take too long, it's too long to turn the units vacant, there's no revenue. So that person lasted 3 or 4 months. Had another person that was, after that, a relative of somebody associated with the complex who had a very good remodeling business going and stuff like that. But it turns out had a very bad substance use problem and was very schizophrenic.
Shocker.
But again, a very skilled person. But just
didn't have his life together.
Didn't have his life together, but then also was always an expert on everything I was trying to do without knowing what I was trying to do. So, hey, John, you got to buy this, or you got to do this, you got to do that. It's like I kind of set up myself with my vendors pretty well. But again, that didn't work out. And then over the course of time, though, here's actually a funny story on this one too. So I found another person that I really, really liked. I saw him on an ad. It was him and his son, and he's still working for us and doing a great job. But I had 2 units open. And I'm a little naive on stuff. I said, guess what? Before my person who we had to get rid of, I said, take this unit, my new person, you guys take this unit. They're side by side. And it's like a war. He's not doing his job. He doesn't know what he's doing. So I got them working on units side by side. So I finally fired the other guy.
The previous guy.
And then the person we have now is doing a great job. And he understands I'm providing him a lot of work, so his fees are pretty reasonable, but I give him regular work. And then for folks out there, sometimes when you're new at this, you're going to look and say, well, it's not a set price on what these folks are charging to do work. I mean, the hourly can go from,
Yeah. 25 to $50.
I was getting 25 to 80. Like, first of all, we're not doing the 80. That doesn't work on what we're doing. And then you got to figure out, okay, do I pay you per job? Do I pay you per hour? And things like that.
So let me ask you a question. When you're looking at all your different deals now, I assume before you go and really take it in depth, you take a back of a napkin and figure your income and your cap rates and all those kinds of things. So when you're figuring your cap rate, are you figuring on what it is currently, or are you looking at the next year, where your first year?
And you're really buying the types of property that the owner pulls out a shoebox with receipts and dumps it on the kitchen table.
Well, the first one, yes, Eric, but this most recent one, I bought 17 units, and I think the prior owner has 300 some odd units. And it's not that I'm necessarily some kind of genius on this, but the way they were running it was very different. Like, for example, they were still collecting checks. They were doing very piecework, maintenance work, and the tenants they were putting in were not the tenants I would put in.
What electronic collection service are you using?
On this building, Eric, I switched over to Buildium, which is very similar.
Buildium.
Yeah, so it's very similar to AppFolio.
Okay.
So it's a web-based everything.
Okay.
Everything involving the property comes in and out of there.
Okay.
Again, I'm not endorsing them necessarily. There's 2 or 3 national ones that are pretty good at that. But Stephen, in terms of what I look for now, I look at what the going in rate is. Mm-hmm. So I kind of look at that as my threshold. And the back of the napkin work, I've been through enough of the spreadsheets and models where I can kind of look at a property, not perfectly, but know if there's any opportunity there without having to go see the property. And then what I'm trying to find now is something that has some upside to it. Meaning, will the market justify this rent? And then also you look at also a lot of it's not always easy to defining what upgrades you want to do.
Sure, because in Florida, for instance, you're buying a property and you're going to figure what your costs are going to be, but certain things like property taxes are going to be a lot more next year because you bought the property, and
you're going to take an 80% increase, probably, or up to there.
So that's another big mistake that investors make.
So you have to factor that in.
Yep.
They don't figure that when you buy, you're going to get an increase because you're paying 30%, 40% higher than the last person purchased the unit for. Mm-hmm. Now you're going to you put the red flag in front of the bull in terms of the property appraiser, so you're going to get an increased tax bill. And a lot of people don't factor that in. All of a sudden, oh my gosh, I got a 30-40% increase in the tax biil. Yep.
It's price plus the fact that you're doing improvements.
Yeah, exactly. Both you get hit both times. Yeah. Changing subjects on it a little bit, John. So Fort Myers is one that you an area like, and you've been looking all up and down the Gulf Coast of Florida. Talk to us about, like, you're looking now in Fort Myers for additional properties, correct?
I am, and this is where it's going to take a leap of faith a little bit too, because the portfolio I have now, the Fort Myers property is going to kind of hit my 1-year target in terms of top line revenue. I got some expenses I've got to control a little better, but it's going to. We targeted to get rents to 1,200. We're getting 1,225 on the remodeled units, so that all has gone well. And then the prior properties I still own, the commercial and the small multifamily, are doing really well. But I'm kind of anxious to get to the next step. So what I'm looking probably going to do is sell the 2 commercial as well as the original multifamily and try to roll up to something bigger in units and bigger in price tag too. But that's a bit of a leap of faith, because just because I sell my properties and have cash and ready to go now doesn't mean they're going to be there. So I'm going to think, okay, what are we going to do if it takes a year or so to find a property? Then if it takes a year to find the property, what if it takes another year to get the property to perform on where we want to perform?
Sure, and it's harder now because the market's strong.
Yeah. So let's talk a little bit about, Fort Myers is an area that you like. Let's talk about that compared to Tampa, St. Pete area, for example.
Comparing rents to the purchase price, it's more favorable there.
Okay.
I'm not an expert in that market, but I was trying really hard to find stuff in Sarasota, Bradenton too. And there's multifamily for sale in Sarasota, Bradenton, but they might be. I think the last one I looked at there was an ideal location for me. It's a 5-point-something cap with literally no upside on the rents. And oh, by the way, it's
scraping everything off the table.
Yeah. Oh, by the way, it's in a flood zone, and by the way, it's on well water. No, I'm sorry. It's in a flood zone and it's on septic. So it's like, okay.
Oh, this and look at the septic, that dent in the yard. That means you have to replace the septic.
Yeah, but it's a nice complex. It's kind of the size I'm looking for. But it's like there's no way to that I could see any way to make more money on that property.
Well, you sort of feel the same way about the septic as you do about the 5 cap, right?
Exactly. They both go
Fall
together.
into the same basket.
There's a correlation there for sure, Steven. So. But no, that marketplace down there, and I think there's only in Lee County, there's only like about 6 or 8 complexes over like 30 or 40 units. So you've got a lot of these mid-sized complexes. There's been a lot of turn down there lately too, though, because the prices have gone up. You still have room to add value and increase the rent accordingly.
Yeah, it's interesting. The way the markets have developed in relation to multifamily. You look at, for example, just look at Tampa area, the Tampa Pinellas area. Tampa is an institutional market. The vast majority of apartments that were built in Hillsborough County were built post 1975. Right. So they are your large 200 plus unit apartment complexes. And then just across the bay in Pinellas, it was the vast majority of them were built in like the 40s and 50s, which are like the 10 to 20 unit. And it's the largest apartment complex or market in the state by far, bar none, by just pure numbers. But when you look at it, proportionately speaking, the vast majority of them are smaller types of complexes, like the sub-institutional level, the sub-50 units. So how would you classify Fort Myers into that market? To closer to Tampa or closer to St. Pete?
Closer to St. Pete. Slightly newer in terms of construction. There's more, I'd say there's a lot more 80s construction there. I literally driving up here today, I've got an email coming to market soon. There's a place in St. Pete. I forget even what neighborhood it is, but it's 20 or so units. But it's got to be a 1940s building. It's a building where you walk in and all the doors are interior doors.
Right.
So I don't even know what the price of it is yet, but that's probably outside of my expertise to go something that old, most likely.
Gotcha.
So as you're looking now in areas, it seems like you're gravitating to stay with multifamily rather than in other commercial.
For the most part, Stephen, I think the next goal too on the multifamily is to get one that would most likely qualify for one of the Fannie programs with non-recourse loans that are $1 million up.
That's where the real juice is too. When you start talking about the debt, is the best in a multifamily.
And the one I bought in Fort Myers before, we almost qualified it for that, but so it's cul-de-sacs. It's townhomes on a cul-de-sac, but then like 3 doors down, we have 2 duplexes as part of the same deal. And that made it non-continuous buildings. So Fannie would not do it, which was disappointing.
Debt plus you got depreciation.
Yeah.
That's one thing, too, is you look at this. Again, a lot of your veteran folks that are on the program know this, but, being full-time on this now, and then you do your first couple tax returns, it's like, whoa. When you put depreciation in there and stuff like that, too, it's amazing where that throws you down.
Wait till you sell him, John.
I know.
Don't worry.
Well,
Sam's going to get his piece.
I just attended a 1031 workshop up here, so that's a consideration as well too.
Yeah, actually, we used to do a lot of 1031 exchanges. A lot of 1031. Our business was built on 1031 exchanges, and it was when we would do it. You're like, well, you're worried about the depreciation, or I'm sorry, the capital gains and worrying about passing that over. But then when you actually saw the numbers on the depreciation recapture, it's like, oh my God, that's the thing that really will just absolutely crush you is the depreciation recapture. 25%. That'll definitely whack you on the head.
Yep.
But anyway, talk to us about, you've gone through this, and for the most part, it sounds like it really wasn't planned. There were a couple of things that happened that led you down another path, that led you down another path, that led you down another path. So talk to 2019 John, talk to 2009 John, and tell 2009 John what he's got to do. Because now 2019 John has all this experience.
I think the main thing is take the first step and don't be afraid to do it. Whenever I do, for me, I always get advice from a lot of people who don't really know what they're talking about. I don't know if you guys ever had that.
That's called a consultant.
But hang
on a second. The guy calls me every weekend, so you know what the implication is, right?
but no, it's like, everybody who's ever, eaten in a restaurant's a food critic, and for some reason, everybody who's ever owned a house is a rental property critic. And I've been fortunate as I've learned, is to seek out people ahead of me that have been pretty good about mentoring me or giving me some guidance. Going back to 2009, I would say, learn this business a little bit deeper, faster, and then don't be afraid to take the first step, because a lot of this time it's just the way we're wired. You don't understand that there's a gap between your comfort level and your potential.
Right.
And your comfort level is going to say, I can't do that, or I'm not going to be good.
There's that leap of faith also, right? That's a scary part.
But it's always helpful, though, to have that person in front of you that's kind of gives you, they may not even know it, but they're giving you inspiration. And then kind of leaving the corporate world, I got to the point where I'm not going to make much more money than I am now. It's very comfortable, what I was doing. And then I'm not going to learn anything new. It means the same people doing the same thing. But I had a choice where it's like I could have said, that job, I think, I managed a group of national account managers, and we were doing about $300 million in sales for the group of accounts we had. And I got to the point where it's about a 30-hour-a-week job. So a lot of people would say, well, just stay with that and do that. But there was no growth there, and there was no further growth for me. And I always kind of need to be at a point where I'm either learning something new and on the other side helping somebody else come along.
Yeah, you need to be tested.
Yeah, you need to be tested. But I would say, that would be my goal looking back. And all the fears you have, the
limiting beliefs, brother. We just sat through that one conference for 3 days.
We did.
Limiting beliefs. Yeah,
I'm still working on that stuff.
Yeah. Lifelong.
Yeah. And then sometimes your mind will tell you if one little thing goes wrong, everything's going to go wrong. So it's like, this guy didn't work out, so they're all going to be bad. You just got to step away and say, no, it's not going to be the case.
Yeah, it's never as bad as you think it is, and it's never as good as you think it is. It's somewhere in between.
Now, kind of on that topic, though, too, it's kind of funny, too, is like all this, I'm pretty analytical, so you work all this stuff out on paper. It's like, okay, here's the rents here. We're going to do these improvements. It's been $8,000 per unit, and then raise the rents to here. Doesn't always go as smoothly as planned. It's kind of funny when you start renovating a neighborhood or a community, the other tenants are like, ooh, so the rates are going up.
Yeah.
It's not as easy as it sounds, but for our Fort Myers property, I think in a year's time, we've kept 3 of the original tenants. And we've turned everybody else. And it works on paper, but it's a little bit of a grind.
It's a lot of work too.
It's a lot of work doing that.
Yeah. So tell us, you're out looking for properties. You're still out trying to find those 20-unit deals, maybe something a little larger.
Yep.
We also talked about some other things offline that you still got some cash to deploy. So if people are listening, tell us about what you're looking for, so perhaps we can help you find some deals.
Sure. Bigger properties, primarily multifamily. If there was something,
Fort Myers, Sarasota, Tampa. You don't care.
I'd say Hillsborough down to Lee County. I'm comfortable with that. Commercial, I would not completely rule out. I'm kind of feel like I have a better comfort level in multifamily in terms of what to do there. And then looking at maybe doing some hard money lending for a portion of the money that I have.
Targeting what, single family flippers type?
Most likely.
Yeah. Okay.
Yeah.
Okay. Yeah, you definitely can do that with IRAs. I know we talked some with the folks at Advan about that. It's easier to handle those types of deals inside of an IRA and get the tax benefits out of that.
But that's something I didn't even think about a year ago, and then just connecting to a lot of the folks that we meet at your meetups as well as some other things too. It's like, okay, you learn new opportunities. So.
Yeah, absolutely. Stephen, anything else before we let John go?
No, John, well, you're on a quest, and we wish you lots of luck, and we'll be talking in a year or two, and we'll get an update. So thank you for being on the show.
Yep, thanks for having me.
Yep, hopefully you got a brand new 40-unit apartment complex down in Fort Myers.
I'd love to talk about it.
Right. And that was John Wilson catching up with us on what he's got going on in the real estate market, mostly from Tampa on the Gulf Coast south. And we didn't give you his telephone number, but we meant to, and I'll just go ahead and give it to you now. He says if you've got deals for him or you want to talk to him about any kind of financing or apartment deals, he's looking for apartment deals from Sarasota, really from Pinellas County south down to Fort Myers. He's very focused on the Fort Myers area, but his number is 941-545-0360, and he also wanted to remind you guys that he is starting to do some lending to house flippers, and if you'd like to talk to him about what kind of programs he has, give him a shout and see if you guys can't make something happen. Stephen, what were your thoughts in talking with John?
Well, it was great talking to John. He has an intelligent way about analyzing. He's cautious, he's slow, but he's going to make the right decision. What was interesting, I thought, a lot of investors talk to us, well, they're looking for upside and then you increase that, and John does that. So do a lot of other people. But John looked at another equation, and he looked at what is the rental income that I can get as a ratio of the cost of the investment that I have to make. And so using that, he's looking at other areas, not just the big metro areas.
Yeah, and it's interesting that he's found some value, seems to find he feels like more opportunities in the Fort Myers area. And so he's looking for something down there, and that's certainly changed the pace. And we've done some work with him here in the Tampa Bay area. And so, we wish him luck in what he's got going on in Fort Myers. But he seems to have John's a smart guy. He's had setting up some systems to really help him not only manage but find additional deals. So we hope he can find some stuff down a little bit further south. Stephen, John was a great guest. Where can our listeners find other great guests to listen to?
Go to www.investfloridashow.com. You can access our archives and also download the app so that you can listen to current episodes or past episodes on your mobile device.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.